First, there was the high return real estate show, now upgraded to the higher return real estate show. Deeper insights, greater value. It's time to build your empire.
Hello, everybody. This is Shecky, and I am here with my amazing and what are you, illustrious today?
Yeah.
Incredible, super talented, super smart business
Oh
partner,
God.
Mr. Jack Gibson.
What do you want?
I want to pull a lot of information out of you today.
Okay.
How about that?
That's fair.
Okay, because I know you do have some knowledge in this arena. I think we got a really, really good topic to talk about today, appreciation in general. And as we all know, there's two kinds of appreciation. One is forced appreciation, and one is just a natural market appreciation. And I really want to dive deep because I think, we get a lot of calls from investors that are always asking about, how do I get properties to appreciate? Because the reality is a little bit of it, some of it is out of our control.
A lot of it.
And that's true. I mean, there
For market appreciation, what we're going to do today is talk about what you can control and how you can force appreciation.
Right. But you can also purchase in a way where you're buying at the right time in the market too. And depending on where that market is too, you should be able to realize some natural market appreciation. So today we're going to talk about how to do all that, because that's obviously, in my opinion, one of the holy grails of real estate investing is when you can actually force appreciation and create appreciation, because it gives you so many other benefits and it gives you other options down the road. So anyway, let's talk a little bit about the difference, right? So, maybe just ask you, in your opinion, what would you call forced appreciation?
That's a great question. So I'll just make this up. How about that?
Sure.
Wing it.
Sure.
No, I think of forced appreciation as where through your efforts in terms of rehabbing a property by doing value add improvements. And we're not talking about like fixing things in terms of maintenance items like repairing a toilet or putting a hole in a wall back together, like what I used to do in my college days. We put a lot of holes in walls that we had to repair.
Yeah.
Totally different situation. This is where you're putting in a new bedroom, or you're putting in, like you did on your property on Guilford, you added in this incredible, third story, like bedroom, master bath. I mean, that thing was great. I love staying there, man. That's fantastic.
Yeah. It's a cool house. Yeah.
Loft. Yeah. So that forces the appreciation of the value of the property up, is these upgrades. I think generally speaking, the more of those that you do and the bigger that you do them, the better the forced appreciation will be, generally speaking. But there are situations where you could do all these upgrades and all these remodels, right? And all you ever do is just break even because it just didn't do enough to force it above, the value of the money that you put into it. So that's my thought. Do you have any additions to that?
Yeah, I have a lot. It's everything you said, 100% agree with. I think the next layer is talking about how do you, especially because you just said, like, maybe you didn't do enough, or you're almost alluding to the fact that there might be some luck involved. And I'm not saying there isn't, there's always some luck, but I think we can control our luck. And what I mean by that is you have to really, really do a deep dive into the research, into the criteria, into the metrics, into really understanding a specific neighborhood, like down to like what's going on these two streets, even the microcosm of a very small area within a neighborhood, to say, okay, it's not just like, for example, greater Indianapolis or north side of Indianapolis. It's what's happening specific in this neighborhood. Is there gentrification going on? What do the other comps look like on this next, street or two and on my street? And from there, then it's also a decision to say, how much can I buy this property for? So we all know that you're always going to have, doesn't mean you will, but you will always have an opportunity to get a better deal on a property that needs work, because the seller knows that they're only going to be able to sell it to someone that is able to do the work.
Yeah, they can only sell it to a cash buyer. The banks won't finance the property if it's in real
Yeah, I mean,
disrepair.
depends on the condition. I mean, you can buy
Yeah.
stuff that needs a bunch of remodeling that's still functional, and a bank would likely finance it. But to your point, that's also one of the nuances too to consider, is how much will a bank finance? And
Yep.
in many cases, that's based on what the property will appraise for. It's a percentage of appraisal. The point being is you have to have an extremely sharp pencil to do this correctly. And also the other point being is you also have to be a pretty damn good negotiator. I mean, not necessarily great, but you have to be pretty good, meaning that, like in our world, when we do this stuff, we're looking at all the metrics way up front. I mean, we're doing all this research on these properties ahead of time so that we don't necessarily have to be, and we're good negotiators, but there's margin in there. It's like if they say, well, you made an offer, but we're going to come back at $5,000 over or $10,000 over, and we go back and forth a little bit. We know no matter what happens with negotiation that we're likely going to be in the ballpark. But that's based on some very, very heavy research up front and understanding what's going on, again, within that little small area and what values look like and all that kind of stuff. So that brings me to really number 2, which is,
Hey, thanks for supporting our show. If you want to find great rental properties that are not available to the general public, subscribe to our Insiders Club email list. Just head on over to highreturnrealestate.com and wait for the pop-up.
how are you doing these rehabs? How are you forcing the appreciation? And you kind of talked about it a little bit, but you were saying stuff like maybe adding a bedroom. And that's like a really good example of understanding what exactly do you need to do to maximize that forced appreciation. So, for example, if every other property in that area is a 3-bedroom property and you have an opportunity to add a 4th bedroom, you slap up a wall, put in some electric. It's not that hard to do if you got good rehabbers. It's not like what I would call a monster project.
Sure.
But at the same time, you have to ask yourself is, do the numbers work? So if I have the only 4-bedroom property in a neighborhood, nothing but 3 bedrooms, is that an advantage or is it neutral? It's likely not going to be a disadvantage, but does it give me that extra bump in value? Maybe there's no comps to support that, right? If everything else is a 3-bedroom. So again, you got to have all that research done up front to understand before you just go, oh, it'd be great. We could add a bedroom. We could do this. There's always lots of things you can do to a property. But the question you have to ask yourself is, why are you doing it?
Yeah, that's a great point, because I think a specific example comes to mind where one of our trusted contractors, right? We love him. He does the 100 or so projects for us. He remodeled this property in a good area near Brookside Park in Indy, which is certainly gentrifying. And
Yep.
it was this huge, like 4 or 5 beds, 6 beds, and so many baths. And he wanted to sell it to us. And we were like, yeah, we want it, but this thing is going to have a hard time appraising. There's no comps even close to that anywhere nearby. So, you did the hard pass on that just because of that situation where, yeah, it was a great forced rehab, forced equity, but then there's the flip side of that. There was no comps. So,
Well, and yes, and I remember that property very well, and I actually like that property.
Yeah.
But it's just like we're going to have a hard time getting financing. The
Yep.
other thing is, let's say that we want to ever go out and resell the property. I mean, nothing's forever. We've had plenty of properties that we bought that, we took our tax write-offs and it worked out well for 2, 3, 4, 5 years or whatever. And for whatever reason, it was just time to move on, right?
Yep.
Like we wanted to pull our equity out. use it to apply for something else that was maybe a bigger opportunity at that time. That's the beauty of being, an active investor and having an active real estate business. This is not completely passive, and you're not just sitting on everything. And I'm not down on sitting on stuff, but that's just the way we look at it.
It's a lot easier life if people just buy, hold, and
well, it is. There's less decisions to make and things like that, but there's also sometimes less opportunities. When we see an opportunity, we want to go after it. We start looking at, okay, the money and the equity that's tied up in this one property could be used somewhere else, and that money would make more money over here, right? So that's the nice thing about being an active investor, is you start looking at it through that lens. But my contention with this particular property was that, how the F are we going to sell this thing if we ever want to get out? Like, what's our exit strategy? And I didn't see one at all. I didn't see any kind of exit. It's like, well, we could turn it into a really nice short-term rental. There's all these bedrooms. It's not that far from downtown. But what if that doesn't work out? Like, what family is going to want to rent a fancy 6-bedroom home in an area where everything else is 2 and 3 bedrooms? And are they going to want to pay twice the amount of rent that we're going to need to make this thing work? Like let's say average rents in that area are 1,200-1,300. We need to get 2,500 for this thing. And they're like, well, once you're up to 2,500, man, you got a lot of choices. So I just didn't see that it was, great job on the rehab, beautiful house. But it just was one of those situations where that contractor, we love him. He's a great guy, but he didn't look at it through the lens that we're discussing right now. He didn't do that research up front. And now he's going, man, I really need to sell this property. I really need to flip it. And he's having a hard time selling it. So, he's probably just going to keep it.
He's got a deal on it, but he's got to show them for 6 months that it's a successful short-term rental. So
yeah,
he's got his work cut out for him to be able to get what he wants.
Again, I'm kind of beating a dead horse now, but so as long as everybody who's listening really understands that forcing appreciation doesn't happen by luck. It happens by really knowing your stuff up front, understanding exactly what's going on in that neighborhood and what's going to be meaningful in terms of the dollars and the value adds that you're putting into that specific property at that specific time.
Yeah. Another strategy that we've done well with, and, we just bought a house at the same general strategy. We are getting a property that does need quite a bit of work. It needs some upgrades. It needs a new roof. It needs, a full remodel, right? But it's just not ready yet. We bought it on the outskirts of what appears to be, a neighborhood that is gentrifying. But if we do it right now, we're going to have a really super nice house, probably two to three times in value of everything around it. It's just not ready yet. So we're going to do delayed forced appreciations. Our plan is to buy these properties where we see, 2, 3, 4 years from now, we see some real gentrification coming, and we'll just hold them until that kind of reaches and gets to our property. And then we'll deploy the construction team, do all the upgrades and really cash in. And we've done that a few other times over the past few years. And that's worked out really well. So that's another kind of thing to consider as part of your strategy is, yes, I'm going to force the appreciation up, but just not yet.
Yeah. And that means, like, I know exactly the property you're talking about. It's not typically a turnkey situation because that property is, let's just say, a little bit grubbier. It's not awful, right? It rents.
It's habitable.
Yeah, it's habitable. It doesn't bring huge rents, whatever. But, we were able to buy it right. And we were able to buy it, like you say, in a situation where we see a lot of gentrification nearby, but not really on that street yet. And so it's going to hit that street because it's coming from like 4 different directions. Like we know it's obvious it will happen. So, we're doing the like, okay, well, let's deal with the grubby property and let's deal with probably a little bit grubbier tenant for the sake of understanding what we know is coming. And, the other piece to that, which that brings up the other form of appreciation. So here's a really good example. I'm glad you brought up that property. For people that are listening to this property, I'm not going to give an address, but it's in Indianapolis, and it's we bought it for slightly less than $100,000. I mean, it's a little 2-bedroom bungalow and tenanted, so great. Given that everything around this is going through a gentrification process, and given that in this area in the last, 3-4 years, we've seen some massive appreciation in this area, this is also a market appreciation play, not just a forced appreciation.
That's a good point. Yes.
So let's say, for example, we don't ever touch it. So let's just say we don't touch it for 3 years and we paid slightly under $100K for it. I have no doubt in my mind that 3 years from now, this is going to be $130,000 to $150,000 property untouched.
And for those 3 or 4 years that we held it, we had rents coming in. We had positive cash flow coming in that covered all the expenses and gave us, a couple $100 extra positive cash.
Yeah, exactly. So no, is it a home run right now? Absolutely not. But it's a really, really great long-term play. That's a really good example of market appreciation combined with potentially the forced appreciation.
And that's how I think you create the fastest wealth, that you can actually control the outcome to a certain extent, right? I mean, you can't control market appreciation, the overall market appreciation, but like you said, if you pick a property in an area where there's a likelihood or pretty strong chance that the market is going to get to you and, appreciate just because of what's happening around it, you're getting a little bit of luck, but you're mostly putting, some skills on your side. You're putting yourself in a good position to benefit from both sides. I think that's how you become a sophisticated investor, is doing deals like that.
Yeah, 100%. And so given that, many of our listeners are in the turnkey world, and I'm not slamming that. I mean, we've done plenty of turnkey deals too. There really isn't that opportunity when you do a turnkey. So then the question becomes, if you are not an active investor, you don't have crews, you don't how do you go about doing that? Right. Well, you really have two options, right? One is you're going to get your hands dirty and get in there and, work with contractors directly and find the property yourself and do all the research and blah, blah, blah. Right. I mean, it's a lot of work. It pays, but it's a lot of work. This is not passive investing by any means.
You've got to factor in, your time and distraction. So if you're running a business, for example, where you're in, sales and marketing, and doing something like this would distract you from what you're really good at and what you make really good money doing, then it's going to end up costing you. You're going to probably take a hit or really just give yourself a lot of hassle for really nothing. So yeah, you got to kind of weigh that. How much is that going to distract you? Going out, getting your hands dirty, lining up contractors, managing the contractors, all the decisions that you have to make this happen. And I'm guessing you're going to go to a second option, which is a more passive way to do it.
Hey, thanks for being a listener. To find great rental properties and become a more savvy investor, head on over to highreturnrealestate.com.
Here's the cool thing. So, our company has been pretty much selling turnkey properties for the most part for the last 7 years. And we've done a few deals where we have done some of this stuff with investors, where we've gotten into the mix and said, hey, you could leverage our contractors, et cetera, et cetera. It's only recently that we've developed a formal program for this. And I wanted to just take a couple minutes to explain it, because I think there are some listeners that this would apply very, very well to. Now, if you just want to be completely passive and you want to just buy turnkeys, this is not for you. If you are a little bit more sophisticated investor and you have, I would just say the stomach for this. It doesn't necessarily, I mean, it's a little bit more of a wilder ride. There are certainly more requirements in terms of lending. You likely are someone that is paying a little bit too much in taxes, and you're working on some level with a tax strategist to understand that if you bought a property that needed work, there likely would be some significant tax advantages for you in doing a certain amount of work to that property. So in other words, what I'm saying is, before I go into this whole explanation of what we're doing, understand that you have to have an understanding of your tax position. You have to understand to say, hey, look, if I went out today and bought, I'm just going to use a rough number, a $300,000 property, and I could spend $80,000 on this property in rehab, I would get such a huge tax break with the IRS. Like, it would save me, I don't know, I'm just going to pull a number out, $50,000 in taxes. Then it's like, well, holy crap, the IRS, in an indirect way, just paid for a pretty big chunk of my rehab.
We've had, and you're not like exaggerating. We've had investors that have done better than that, right? What's the most recent example? Wasn't it saved like I don't want to speak out of turn, but it was substantial, north of $100,000.
Yeah, and their expenditure was well north of 100. I want to say it was 180, 190 in their rehab, but they got approximately 100K in tax breaks because the way that the books were done. I mean, again, this goes back to now one of the reasons I was making such a point about talking about upfront research and understanding what you can do. So the decision of how to rehab a property now isn't just based on what's going on in the market, but when an investor looks at it, they go, well, how much should I really be spending on a rehab aside from what I'm doing? It's how much am I doing in terms of dollars, and what are the implications for me in terms of my tax bill with the IRS? So again, that's just another way to, again, in an indirect way, make that particular project even more profitable, right? Get some help from the money you wouldn't, if you would have paid the IRS anyway. It's like they're kicking in for your project now. I mean, we're never going to get away from taxes. We just have to do everything we can to minimize it. Here's the way it works. This is just super cool. We developed a program called AIM, AIM, Advanced Investor Model. And again, obviously not for turnkey people, but for people that really want to participate in what I call a home run. Probably a little bit of market appreciation, but a great amount of forced appreciation. But like leveraging a turnkey property's expertise, now you're leveraging our expertise to do things the way we do them, because we're the company behind what was once exclusively turnkey. So we've gone out and understand the marketplace. We have all the research in place for the different criteria of what we're looking for our own properties. We have management in place. We have all the contractor relationships, and we also understand how to write up the rehabs and line item the expenses such that it would benefit you to go work with your tax strategist and say, okay, here's how we're going to save a bunch of money on taxes. So it gives you all the parts and pieces of everything that we do for our operation. We're allowing you to leverage on all of our systems and everything in place that we do to build our own portfolio. And so this is not something that's been available for that long. We kind of, test marketed it with a few different investors, and now it's working pretty well. But just understand, if it's something that you want to do, this is, we're going to have a pretty lengthy conversation about it. And you're going to obviously have to understand your tax position going in. And you're going to have to get pre-approved in terms of financing and have certain cash positions to make this work, which we're happy to go over with you individually. But if you're really wanting to go next level and graduate past what I typically call the armchair quarterback version of real estate investing, which is just strictly turnkey. And you're wanting to go to that next level. But like to your point, Jack, you don't have the bandwidth because of your job and your career, and you're busy making better money over here. You don't want to be a rehabber. We get that. Then this could potentially be a really, really great program for you.
So kind of lay out how it works. And do you have an example of a property that we could give them maybe some specific numbers? Like, how does this work in terms of the whole flow?
I'm going to go over that part pretty quickly because I think that that's probably better for a phone call. But that said, here's really the highlights. You're going to go out and get pre-approved. When I say you, I'm talking to you, the listener right now. You're going to go out and get pre-approved. You're going to get a certain amount of money. You're also going to work with a tax strategist and you're going to go, I know I need to buy X and spend about this much on rehab. I have the proper pre-approvals for purchase, and I have the cash necessary to do everything else. Okay, cool. From there, we're going to then go out and do the research for you. We're going to go out and find you a property, and we're going to go get it tied up. We're going to get it under contract and make sure and do all the research. And we're going to actually get our contractors in there and make sure that everything is going to, there's obviously, you're never going to have perfect parameters, but fit within the approximate budgets that you're trying to work with, and say, okay, here we go. Here's our plan. Here's the property that we want to buy. Here's the rehab that we want to do. Here's what the rehab's going to cost. Here it is. Just lay it all out. Here's the current condition of the property. Here's what, obviously rehab is not just adding the bed and bath, but, like to your point, maybe it needs a roof. Maybe it needs, here's all the things we're going to do to the property. Right. And by the way, here's also the strategy at the end for whether it's going to be long-term, short-term, medium-term rental. And the only reason I'm bringing that up, and that's a whole nother conversation, is because it gives you other options. Because typically the areas where you're going to want to do this, where you're going to get a little bit of market appreciation and some good forced appreciation, is in what I would call sexy areas, right? There are areas that are trendy and they're cool, they're coffee, the places where people want to be. So that's where it really makes the most sense. And that's obviously where you're probably going to have more luck with short and medium term rentals, which again, side note here is that means you're furnishing those properties too, which creates an additional expense and at the same time creates another monster tax write-off should you choose to go in that direction. So what we're going to do is we're going to lay it all out for you. Here's the price. Here's the rehab. Here's what your options are for rents. You tell us what you want to do. We're going to go out and get the property under contract. We're going to then assign it to you. We're going to sell it to you on assignment. I want to be very transparent here. We're taking ownership for the 5 minutes of, that the title company is basically just, look at it as A to B, B to C, right? A is the seller. We're B in the middle. We're then selling it to you in the same closing package. And for our efforts, we absolutely 100% are taking a markup. Okay. I want to be transparent. It's a lot of work.
Yeah. To put a team together to be able to do this. How many people do we have behind the scenes that we have to pay to make this happen?
A lot.
A lot.
Yeah, a lot. There's researchers and people making offers and, earnest monies and contractors and inspectors. And there's a lot that goes into this, right? So the markup that you're paying is for all of that. It's for all of our research and know-how and knowledge and for leveraging our systems.
And leveraging contractors to where we know they're vetted. We know they're going to do a good job.
Yeah.
You're not going to get screwed over.
Yeah. And look, you're going to see a bid. You're going to know what the price of the rehab's going to be, within reason. Obviously there's some variance and depending how much time it takes, prices of material sometimes change but you're going to have a very good idea of what you're getting into. So anyway, We're very, very excited about this. Needless to say that this is a lot of work, and it's a big deal to do one of these. So it's not like if you're listening to this, and we get, I don't know, let's say 10 people that reach out to us and they all say, okay, all 10 of you want to do it this month. There's no way on God's green earth that we're going to be able to do that. So I just want to be clear about that too. This is very onesie twosie, and it's a very, very special situation, but it does work for us because there are times when we're not, leveraging all of the tools that we have to the maximum capabilities. So it's a win-win for us as well too. We make a little bit of profit, we make a little bit of markup, we keep our teams and crews busy in a period where maybe we're not buying anything this month because we've got other projects we're finishing up and whatever, right? It's really a great, great situation. So that's pretty much a wrap. If you're listening to this and you think that this AIM program would be meaningful for you, then by all means, reach out to us. You can write to me directly, Shecky, SHECKY, at highreturnrealestate.com, or you can write to Jack at highreturnrealestate.com. Send us a note. We can hop on a call. We can talk about, some of the different projects that we've done, some of the things that we're looking at right now, and see if we can't put something meaningful together for you.
I love it. I always want to be in the driver's seat, when I'm trying to build my wealth, right? I'm okay with some level of my assets being in the hands of the public markets.
Yeah.
But if you really want to be in control, you want to be the one directing your financial ship. These kinds of strategies that we're talking about allows you to put more of your own control factor into developing and growing in, your wealth. So I love this model, Shecky. And I think that if it's the right person, it's definitely a no-brainer for them to do it.
Yeah. So what you're saying is you're inviting all the control freaks to write to us now.
The type A's, maybe is a better way to put it.
No, I'm just teasing. Anyway, you're listening to this. You know who you are, whether it's meaningful or not. We're happy to talk to you. I'm just joking around. Anyway, Jack, thank you. It's just been great to connect always. And I love what we're up to. And we're continuing to evolve and increase our offerings. And, it's all good.
I do have one more question. Do we have a couple of these AIM properties available right now?
There are one or two that might work. There are ones that wouldn't be done on assignment because they're stuff that like maybe we just bought and we were going to take for ourselves. And maybe we already started the rehab, whatever. So just understand if you're doing something on assignment, no, it's not something that we currently have under contract. So to answer your question is yes, there are some hybrid situations where we already own the property and we've already done some of the rehab. They're furnished, so you could still get in and pay the furniture and take that right off. And they're likely on bigger, lot size properties where maybe they could handle an additional dwelling unit. And there are other opportunities for future write-offs. But AIM in general would suggest that, no, we don't own the property yet. And we're going to go out and actually look for something specifically for you that does need work and hasn't had any of that work started. So it's a good question only because currently there are a couple of hybrid availables. But that could change tomorrow. Like who knows, right? But
I think there's one other question that I need to ask before we adjourn. What's the cash flow situation like on these properties? I mean, are they going to just be gushing free cash flow, or is it maybe a lower cash flow net and you're going to get a better appreciation play and a better tax write-off? I mean, it's really tough to get all the best of both worlds where you have really high cash flow, really high appreciation, really high forced equity, right? Really high tax advantages. I mean, those are unicorn properties.
Yeah, it's a great question. I'm actually glad you asked it. I don't see currently, we're recording this, April 2023. I don't currently see an opportunity. Well, I shouldn't say it. I'm not going to use those words. I currently don't see all these properties gushing cash flow.
Mm-hmm.
The big play on this is some market appreciation good forced appreciation and phenomenal tax write-offs. That's where the money's being made. So again, if you're an investor that just looks at things through one lens and just say like it's all about, cash on cash return, then this likely is not a good model for you. But if you're saying like, look, there's a lot of other ways to make money, especially in a market where, let's face it, a lot of things appreciated and were very inflated over the last couple of years. Now they're cooling down a little bit and we have some slightly increased rents, but we don't have the same price to rent ratios that we enjoyed 3 or 4 years ago, pre-COVID, let's just say. So we have to take that into consideration. And that's why we do stuff like this too. It's like, okay, a good real estate investor, I like to think we're pretty good, can make money in any market. Their strategies can shift and they do things based on what's going on in that particular market right now. Now, that doesn't mean that you couldn't get a property that gushes cash, because sometimes that goes back to the question of luck. Maybe you turned this property into a short-term rental. And maybe, just maybe, the pictures are awesome and the furniture is great and everything is just perfect. And, the thing is put up, say, on Airbnb or VRBO or whatever, any of these other platforms, and it just gets a lot of attention and a lot of renters. And it can gush cash flow. So the opportunity is there, but I don't want an investor to think that that's the play.
Yep.
That's a nice bonus if it happens, but otherwise consider that you're likely not going to have gargantuan cash flow. Like you'll have some, right? But when you get that nice small IRS tax bill at the end of the year that you otherwise would have had, it's like, wow, I'm so glad I bought that property, right? Like there's other reasons. And then, 3-4 years from now, you're going, wow, this thing is worth way more than what I've got into it because of the market appreciation of holding it and because of the forced appreciation that I did shortly after I purchased the property.
Shecky, what's interesting is that when I got into real estate, back in 2015 and in a real serious way, I was all about cash flow. Everything that I was buying real estate, that was the lens that I looked through real estate with, is how much cash flow is this going to produce? And not knowing, being a new investor, not realizing that like that's the least valuable of the benefits of real estate investing. From what I've seen, most of the money I've made is in forced appreciation, market appreciation, and the tax advantages. Cash flow has just been fine, but it's not been life-changing. The other parts have been life-changing.
Yeah. And to your point, I don't think there's anything wrong with looking at cash flow. It's an important metric.
Yeah. You want to have a positive.
Yeah. But to your point, like there's a lot of other ways to make money.
Yep.
That's just one little piece of the pie.
Exactly.
So, thanks so much. Thanks for all of you who tuned in and listened. If you want more information, you want to reach out to us, or if you just want to say hi and tell us that we're badasses and you love our podcast, you can always write to us. Shecky at High Return Real Estate, Jack at High Return Real Estate.
All right. Thanks, brother. Here we go.
Yep.
Hey, thanks for your support. If this episode was valuable to you, then show us some love. Subscribe and take 1 minute of your time to leave us a review. This is how we get the word out to help more investors. And best of all, it's good for your karma.